Dave Skirman of First Ontario Credit Union, back for more viewer questions. Good morning to you.
Good morning, Annette.
So we're going to get to Janet's question from Stony Creek because we ran out of time on our last Finance Friday. So she asks, my husband recently passed away, and I'm wondering what would be beneficial for me to do with his life insurance. Do I invest in GICs, stocks, etc.? I'm hoping to use the interest to help offset the loss of his income for living expenses.
Well, thank you very much, Janet, and obviously very sorry about your husband. He had the good sense to have life insurance, so that's perfect. Insurance, of course, is meant to cover a loss. We can't, replace Janet's husband, but can replace some or all of his income. So Janet needs to take that lump sum that she gets from the life insurance and turn it into a regular income. And there are some options. So one of them is an annuity. Annuity's been around for a long time. It will provide a regular income for Janet for the rest of her life, as long as she lives. The downside of an annuity is it's based on current interest rates, and interest rates, even though they're gone up a little bit, they're still low. And also the lump sum's gone. So even though you're going to get a regular income the rest of your life, you're not going to have anything for the estate if that's important to you. Another option that Janet mentioned is GICs. That'll keep your principal amount and also give you a regular income. GICs, again, right now the rates are fairly low, and they would probably provide a little less actually than an annuity. Another option is some dividend stocks. You mentioned stocks, but the kind of stocks you'd want to get is good companies like banks, utilities, Enbridge, Telus, Bell. They have a history of paying dividends every quarter, so you can keep your stocks in place and not have to touch them and spend those dividends. That would actually be a good option. Another option is mutual funds or exchange traded funds, and you can buy dividend funds there, or you could buy a balanced fund that you can start taking out some gradually. So those are some options. The best advice I would give to Janet, though, is to sit down with an advisor and look at her particulars and make sure she makes the best decision.
Okay. Our next viewer wants to remain anonymous, but thanks you for all the good things that they're learning from this segment here on CHCH. So their question is, if siblings own their own homes and inherit their parents' house, is the inherited house considered a secondary residence for all of the siblings? And therefore, when it's sold, do they have to pay tax on their portion of the inheritance? Good question.
Yeah, that's a great question. And there's no inheritance tax in Canada, so we're very lucky in that. The deceased actually has to pay, or the deceased's estate has to file a final tax return in the year they die. So taxes are paid on everything before they're given to the people that are inheriting it. However, the principal residence, there's no tax on, so that's great. And when they inherit it, the siblings, there's no tax on it. But the value of that house is going to be determined on the date of death. And if they don't sell the house right away, then any increase in value of that house before the date it's sold, that will accumulate what we call a tax capital gain. And you'll have to pay tax on that capital gain. Again, it's not a bad thing, because if the value goes up, you're going to earn more from it, even though you have to pay a capital gain. But from the house itself, no, you're not going to have to pay any tax on it.
Okay. Our last question here, and we got about 90 seconds left, is from Paul in St. Catharines. Says she has a joint account with her daughter. A preauthorized debit was to come out of her account, but there were insufficient funds. The bank took the money to cover the debit out of an account that was in her name alone, and then the bank also took funds out of another account that I am joint with an entirely different person. Can the bank take funds to cover debits from my bank accounts and those that I am joint with other people that are entirely unrelated?
So it doesn't, it is a little bit confusing, and a lot of people don't understand this, but when you have a joint account with someone, all the joint account owners on that account are equally responsible and also have equal access. So even though, she called the account her daughter's account, if she's joint on it, it's really not her daughter's account, it's their account. So it doesn't matter to the financial institution who actually has the debit or the payment coming out of it, her or the daughter, it's theirs. And if there's not enough money there, then they can go to any account that's in the name of either her or her daughter and take that money out.
Okay.
It's called, that rule is actually called the rule of offset. And you can Google it on the Bank of Canada. Or Government of Canada, and it can happen. So you have to be careful when you have joint accounts.
Okay. Consider it your own then. Thanks very much, Dave. And if you have a financial question or topic that you'd like covered by Dave, email your questions to financefriday@firstontario.com or get in touch with Dave through Twitter at finance_Friday. And if your question or topic is covered on air here, you can win a gift card from a local business in your community.